Hey everybody, and welcome to the Stock Market Basics for Beginners in Trading, the Investors Tutorial course. Basically, it's going to be a free investing course. I'm going to cover all the different aspects of trading from basically what a share is, what the stock market is, what a stockbroker is, all this, a lot of this more basics of trading if you're just getting started. So make sure to listen through the whole video, otherwise you're only going to get part of what this is all about and what this video is going to be about. I'm going to go into detail about it. This is more of a beginner course. I'm going to be doing more advanced stock market trading explanations, things like that in other videos, so make sure to subscribe to the channel if that is something you might be interested in. But we're going to get started here. Stocks are pretty straightforward. You go to the stock market, you buy a share, and you sell a share. You join a stockbroker, and through that stockbroker, you can buy and sell those shares at any point you want. You can do it on a mobile device, you can do it on your laptop or a desktop. You can even call your broker. That can get kind of expensive depending on what kind of trading you're doing. And the short answer is when you buy a stock, you buy a piece of the equity as per Investopedia explanation here, and that means that you're buying just a little portion of that. So if you buy a $10 share and you buy 10 of them, you have $100 worth of that share. So if it goes up even just $1, you have the 10 times magnification because you own 10 shares of that. So the $100 and it goes up $1, you make basically $10 off of that because you make $1 off of each and every share. If it went up $1, if it went up 1 cent, you'd make 1 cent off of each and every one of those shares. Not as exciting as the first one there, but it adds up. There's two types of shares. You got common and preferred uh, equities, blah blah blah. So you main distinction between the two is the common shares usually carry voting rights, and then you have classified in terms of their voting rights and blah blah blah, different types of voting shares. All of that isn't really relative to a smaller time investor, so I'm not going to get into too many details about that, but essentially it gives you more power the more ownership of the shares that you have and the type of shares that you have, and that in turn gives you more power to vote on certain things through the company and a lot of that stuff. But ultimately, unless you're a big baller here, uh, throwing out like thousands or hundreds of thousands of dollars into a given stock, a lot of that isn't all that relative to you. But the short answer is it just gives you more power over what you feel might be going on with the stock itself. You have the stock exchange, there's different indexes, there's different markets. All that's not all too relative if you're going to be sticking towards mainly the US markets. Some shares of some companies are only available through that particular market or index. So if you're in a country outside of the US, you might not be able to trade a ticker in the US and vice versa. There's ADR stocks, or they're basically foreign representations of the stock in the company in another country. Not going to get too much into that because we're just covering the basics here, but next thing I wanted to cover is the different types of trading. We have the scalping, momentum trading, technical trading, fundamental trading, and swing trading. Scalper, pretty self-explanatory. You want to scalp here and there, in and out, very quick, maybe seconds, minutes, depending on what you're doing. This is not recommended for a beginner trader. If you really don't understand what the bid and ask spread is, bid is basically the current bidding price. Ask is what someone wants, what someone's expecting to sell their given shares or whatever they're holding at that price. Momentum is basically, let's say Apple has news about some big event. Everyone's getting excited. You're trading that momentum and that hopefulness of a continued rise on that. You're following the trend basically. Technical trading, you use indicators and stuff like that. I'm going to get into that here in a second. But you follow different little charts on a line. It seems kind of complicated, but once you kind of get the point of what those indicators mean and what they do, it can be sort of beneficial to you in the trading without having to do all this complex math and everything all the time, every time you're trading. Fundamental trading, you're looking at things like news reports, you're looking at filings for the SEC, as swing trading, pretty straightforward. You're holding shares for a little bit, expecting some kind of big news or momentum or something coming up that might be interesting to you. We're going to get right into it for some of the indicators, though, here. You have a VWAP. VWAP is basically a weighted volume, hence the weights I just showed you guys there. You're measuring it based on the amount of volume that is coming in, and that averages that out to this fun little statistical, whatever you want to call it. And essentially, you can see what the average area that they're buying in that particular time frame. There's different time frames that you can follow, but the WAP stays relatively the same no matter what. It's calculating more on the volume of. So let's say if someone buys in a particular chunk of time, trying to keep this basic for you guys without getting too complicated for those new to trading, but if they buy a big chunk of whatever shares at a certain time and there's a lot of volume coming in, there's a weighted average at that particular point, and that creates kind of like a resistance and support area. The support is like the bottomed out area, supposedly, not a guarantee, and then the resistance is something that they're trying to break through. You could see it on some charts where you might see them trying to push and push and push, and it just doesn't quite make it through, or it breaks through, and then there's a big run up after that, after they break through that resistance or break through that support on a downtrend. Bollinger Bands are pretty straightforward. Think of it like a rubber band. There's a lot of complicated math into it, but ultimately it's a rubber band. The more you stretch that rubber band, basically, the more strain essentially you're putting on the given stock. These are good to follow on the hourly range, in my opinion, but as you can see here, just a quick little chart here. So when you see it stretch and hit a certain range in the Bollinger, if you see it extend beyond the Bollinger, especially on an hourly time frame, that's a lot of strain and a lot of pressure trying to push it in that range, and it usually snaps back into the middle there. So it's literally the definition of a rubber band. You can only strain a stock so much before it snaps back into its more relative support area through the day. This is great to watch on an hourly. There's other ways you can look at it. If it breaks out of that band, it can result in a nice squeeze, much higher or much lower. Not going to get too much more into that, just trying to keep this basic for you guys, just to get some ideas of the basics of some technical indicators that you can add to pretty much any broker that you're utilizing. This is moving average. I chose boxes to represent it. Similar to the volume weighted, the WAP basically, it averages, moving averages over a longer period of time, the range that the stock's been trading in. And it just assumes based on that math that that's likely the range it's going to continue into. You can get more specific ranges depending on how tight your time frame is. But that's relative to you, and that's relative to your own personal settings. You can experiment with it and see which time frames work best for you. Ultimately, you can get a sort of relatively good degree of what works best after you do a lot of trial and error. There's no right or wrong correct time frame. It's all relative to how you're trading. Last one here, not as important as people like to make it sound, but I'm going to bring it up anyways because a lot of people are going to ask about it no matter what. It's RSI, it's a relative strength index. It's kind of similar to the Bollinger Band where you can only strain a stock so much. The only problem is that the sensitivity to the RSI is kind of varying depending on your settings, and it can give you kind of some false alerts depending on what particular ticker you're trading and everything like that. You can sort of use it in the background with the other technical indicators and kind of get a balanced area over time. But ultimately, you're not going to quite get what I'd consider a viable result. RSI is basically just strength, It's measuring the strength at a given point in time. Uh, you can see a lot of complicated math, but that's ultimately what it ends up being. Is there a lot of pressure? Is it overbought? Is it oversold? It's a very basic indicator. There isn't a lot of value into it. There can be depending on your settings, but that gets a little bit more complicated. The default settings for RSI on most brokers is pretty terrible. We're going to get into the less exciting thing. I mean, some people might find it exciting. There's fundamental analysis, fundamental trading. You're not trading based on technicals. You're not trading based on anything else. You're trading based on the news of the company. You're trading based on the fundamentals of the company. You have, things you want to look for, like the industry it's in, the financial statements, press releases, news releases, domestic political conditions, trade agreements, and external politics, competitor analysis. How are others doing comparatively to that particular stock? Some things you'd want to look for are, earnings per share, price to earnings, price to book, return on equity, and beta. I'm going to cover all that here. Just really quickly, they're going to go into more details about it, but I'm going to keep it basic. Earnings per share relate to the portion of profit allocated for each of the company's share. The EPS is an indication of the company's profitability. Obviously, a good EPS is a good thing for the company. That means they're generating more revenue per share, per value of those companies' shares. Uh, Relatively speaking, it's good to look at through a guidance point of view when if you're looking at like an earnings report or whatever, and you see a good EPS or an EPS above what it was before, that's a good thing. Now, this next one here is one of the ones you want to look at, more in just a broad way if you're, doing fundamental analysis here. The PE ratio is basically shows the company's payouts compared to the price of the stock. In other words, the PE ratio shows what our share of stock pays well compared to its price. And then the PE basically profits. You can kind of balance it out, price to earnings. A good example of something that's completely overvalued is Tesla. Tesla had an over 1,000 PE. They're pricing the valuation of the company and its future almost 1,000 times what it's actually making. Not a good valuation, not a good stock to consider trading for a long-term investment. You could trade it on a swing. Hype, there's hype in association with Tesla, but the point being is that you don't want to trade anything long term with such a high PE ratio. You got a price to book ratio, indication of how much stock worth compared to the book value of the company, PB ratio, similar to the PE ratio. What is the raw book value? What is it actually, without counting much of anything else, just what the actual value is based on the book ratio. It will have a book value per share, blah, 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 blah. If the stock trades at 80 per share, then the price to book it ratio is 80 divided by 20. PB ratio, price share divided by the book value per share. If the PB ratio is more than one, this means investors believe that the stock will grow at a faster pace. Uh, as you can see here, kind of a broad range, especially with the way that the stock market works. It's like a hype stock market rather than an actual valuations stock market. Companies like Tesla traded upwards of $2,000 a share, and they weren't really ever profitable. They were temporarily, I guess you could say, but if you look into their filings, they really weren't doing so great. But not going to go too much more into that with Tesla. You got the return on equity. The return on equity is a measurement that determines how efficient a company is when using the shareholders' equity. Calculate the ROE by dividing the shareholders' equity by the company's net income. If the company has generated $5 million this year and the shareholder equity is $50 million, that means the ROE is this percent, 10%. Note that you calculate the ROE result as a percentage. The higher the ROE, the more efficient the company is. Obviously, the higher percentage, the better. Pretty straightforward. Not very complicated in that regard. You're just valuing how much of a return on equity, how much of an expectation of potential future profits, how fast it's kind of like a growth measurement of the company and what it, just a basic for a long term if you're considering it that, hey, look, they're making this much revenue per whatever given dates, blah, blah, blah. You get the point. The beta gives information about the stock price correlation to the industry that it operates in. Beta usually varies as -1 and 1. Sometimes value go much lower than 1 or much higher than 1. Obviously, the volatility plays a lot of parts on this. Beta is most important towards like things like ETFs and stuff, which I'll be getting into in this video, so don't worry about that. But the short answer is higher beta is good and bad. Higher the beta, the more volatility. So if the stock is going up, your ETF or whatever you might be holding is going to go up much more rapidly or fall much more fast, depending on the direction of where the stock is going. Obviously, you want a high beta, but not too high of a beta. You gotta blah blah blah. I'm not gonna go into all this here. It just goes over all the different aspects of everything that was just covered already, that I already talked to you guys about. Uh, Technical analysis I already covered to you guys. The main thing is technical indicators, but you got candle patterns, chart patterns, trend lines, channels, indicators, oscillators, price momentum, trading volume, volatility. Not going to get too specific into that. The short answer is technicals are, charts, fundamentals are more research oriented. If you want, a quick reference, you can use a tool like Finviz. This is absolutely free, costs absolutely nothing. I'll mention that in the description below, but these are different kinds of filters you can sort it out from that I already covered with you guys. Just rough basics on here. If you're still a little confused on the terminology or whatever, investopedia.com is a good resource. Covers all of these much more in depth than I could probably cover if you want to look more into it. I'm trying to keep this as basic as possible for those just starting out as beginners to trading for investing in this course, basically. This course is completely free, obviously. And I'm going to go in a little bit more details here with some other stuff here for the fundamentals. There's different forms that you want to make sure that you learn, but before I get into too much into that, we're going to start with the registration statements. Provide investors with an understanding of the securities that the company offers and the profitability of the company. All publicly traded foreign and domestic companies must file these statements or qualify for an exemption. Prospectus, a legal document that charges any company that issues securities with providing details about the investments it offers, how the business operates, blah, blah, blah. All the basics, as you can see. Then additional information. In addition to the prospectus, the company may provide any relevant information, for example, any recent sales of unregistered securities, so on and so forth. Form 10K, basically a detailed analysis of the financials. Not a whole lot to get into there, but the business summary. The MD&A provides an explanation of the company's operations, financial outlook, financial statements. The financial statements may include the company's balance sheet, income statement, cash flow statement. Very important, depending on the company. Some just rely on hype. Whether they're profitable or not doesn't seem to matter. It goes based on the guidance. Others fall more on the SEC filings and forms. You get the Form 10Q is a truncated version of the Form 10K, so more simplistic, broad range to get an idea of what the financials are. Very important. Form 8K, major company developments. Let's say there's a merger, there's something else going on. Those are what you're going to kind of see in that aspect. 8K can be very dangerous too, because if you see a Form 8K file, that could indicate a potential bankruptcy, something along those lines there. And proxy statement. The proxy statement, investors can view the salaries of the management of a company and any other perks that a company's management is eligible for. Sort of relevant in most cases for most people, not too much, especially if they're just day trading or swing trading. Long term might be a little bit more interesting to keep track of that kind of stuff. Forms 3, 4, and 5, all corporate insiders defined by the SEC as a company's officer, so on and so forth. These forms are meant to reveal more information about the securities that the company insiders own. So buys and sells of said person, the insider involved with the company. You can get an idea of what they feel the value of the company is, how much they're selling of that company, so on and so forth. Next thing I want to cover is basically, the risk, the cost basis of this. Do you need a lot of monies to trade? Yes and no, depending on the type of trading you're doing. Are you going to be doing scalping? Are you going to be doing swing trades? Are you going to be doing long-term trading? All relative to how much you intend to spend. Some people could trade with just 1,000. If you're doing, lower cost ETFs, you can still make a decent amount with $1,000, $2,000. You can turn it into 50 to 100 a day or even a week. It doesn't sound like much, but you're not really risking a lot of capital now. If you're trading something like options, if you're trading something like if you're just day trade trying to scalp, you're not going to get a lot of monies out of that with just a few thousand, $5,000 to $10,000 a day. Probably a little bit better off. A little bit more flexibility in the day trading. You need upwards of $25,000, but you could day trade with much less on a cash account. And I'm going to get into that here in just a second. But then you also have to factor in that there's trading expenses. You got commissions and you got taxes, all this kind of stuff. Relatively speaking, you generally shouldn't be trading if all you are working with is a minimal capital because you're going to be trading with emotion then, and that is not a good idea. Now we're going to get into some basics of brokers to consider. TD Ameritrade. TD Ameritrade is great for charting, technicals, things like that. You get live news alerts from places like Benzinga and all that kind of stuff. Webull, swing trading, great for shares. Very simple to use, very it's not very complicated and it's free trading, so it costs you nothing. TD Ameritrade, free trading for shares, costs you nothing. Pretty straightforward. TD Ameritrade, we will. Tastyworks is more for options trading, but you can get some options research on that. I cover a little bit about options trading in this video, but I'm not going to go too much into depth because I'm going to be doing a more lengthier video about options trading. So make sure to subscribe to the channel if you're still listening in this video. And we're going to go into what a cash account is and a margin account. I sort of briefly touched up on that. Cash accounts, basically, you're not borrowing monies, you're not doing anything. You're just spending your own monies to do the trading, buy and sells. Transactions can be a little slower, but cash accounts have their own benefits. Cash account, you can, in essence, trade kind of indefinitely. You get good faith violations if you try to trade over that given cash amount. That's just part of the SEC laws. Nothing you can do to get around that. Uh, basically the short answer is it's slower to get in and out of with that cash, slower to withdraw the money, slower to deposit the monies. Uh, it's just a slower process, but you're only using your monies. You're not taking any cash out on loan. Margin gets a little bit more complicated because if you're on a margin account, you can take out a margin loan to borrow extra money to trade with more leverage. What that means is that you're basically taking out a mini loan in order to trade with more capital, but you have interest rates and percentages that cost monies over time. And then, of course, if your stock goes the wrong way, you're going to get margin called. Margin called basically force sell some of your position. So if you're not okay with that, do not ever use margin. I would recommend for new traders to never touch margin, but the short answer is margin is basically you're taking money out on a loan. That's why you get quicker transactions. That's why you get quicker withdrawals from your bank, because you're essentially borrowing money in that temporary state of holding. Pretty straightforward. We're going to cover some risks here to trading. Obviously, you're risking capital. So if your whatever trading plan isn't working right, you can lose a lot of capital. I would recommend paper trading. Paper trading, you can make essentially a virtual account that costs you nothing at all, and you can utilize that paper trading account for pretty much whatever purpose you want. You can try different strategies and what have you. It costs you absolutely nothing. It gives you kind of a virtual cash amount to utilize to try see how that works. I'll leave some links in the description below if you guys want to check that out. Obviously, the other thing with trading is that you can acquire an addiction. Addictions are obviously not a good thing. Smoking's a bad thing. Drinking's a bad thing. You have to trade in moderation. You have to control yourself. A lot of people start to trade and then get addicted, and then they end up losing monies, or sometimes gaining monies, but their addiction just grows more and more and more. You don't want to be essentially chained to the desk there. You want to be free. The whole point of the trading in the first place is to get freedom, not be chained to your desk and lose your freedom because you become, obsessed with that trading. Obviously, something else to consider with risk management is that depending on how much you make, depending on your tax brackets for whatever jobs you might do outside of trading, there is taxes, and obviously taxes cost money. And if you don't pay those taxes, you can get a lot of fines. You can get a lot of legal trouble for those problems. So that is something else to factor in, depending on how much you make, how you trade. Obviously, short term, there's costs. Long term, there's costs. If you're doing short term trading, your taxes are generally higher. Whereas you're doing long term, if you're holding for at least a year, your taxes are generally lower. You can get in IRAs and mutual accounts. These are like long term savings accounts, but then they lock up your monies until your 50s or 60s. Personally, not for me, but it's something worth mentioning in this video that essentially there is retirement accounts. If you're interested in learning more about them, contact whatever broker you decide to utilize, and they will give you a whole bunch of information on that. You can call them, you can email them. They're very excited to tell you because they make a lot of monies off of that. Already mentioned, don't trade with emotion. Emotion can cause, obviously, strain. So if you're limited in capital, you shouldn't really be trading. You should be trading with monies that you can afford to lose 100%. That way you have no emotional attachment and you're just simply trading to try to make a profit. Sometimes that's hard for some people. Some people can't do that. That is just a part of trading. And we're going to go last little bit here. It's kind of reloading here. I'm not sure what's going on. So we're going to skip that part there. Okay, there we go. It was just taking a little bit. And we're going to go back to full screen. Sorry about that. And but basically, different risk management tips. Always follow your trade plan. Never go all in with your portfolio. Obviously, there's such thing as scaling in and scaling out. If you're up a little bit on profit, think of how much that would have taken you to make in your day job. Obviously, this is not a get quick rich scheme kind of thing. You have to take time to build those profits. Do not revenge trade. If you lose on a trade, don't try to get in to try to make back that trade without following any kind of trading plan. Obviously, if it goes against you, get out, reassess, and then re-engage and re-get back into it. Uh, Options trading, if you're not familiar with options trading kind of like a time clock. The longer you're in, the more the money decays. I'm going to get into options trading just briefly in this video, but I'll cover it more extensively in another one. Obviously, the breakouts can be deceptive. It's a lot of market psychology going on. You want to trade within the expected predicted move. Places like Tastyworks show that pretty clearly. You can look up more on that through Investopedia, but essentially it's the range in which the options are flowing through and the volume's flowing through. It's kind of like the VWAP that I mentioned earlier. It trades in a relatively tight range. And then, of course, we're going to get into a little bit more information here into just more general investing. If you want to take a little bit of less risk, you have ETFs. ETFs are kind of like a bundle of stocks. You can trade them however you want. You can hold them longer term, but essentially it's like trading a whole sector rather than an individual stock. You have stocks like DFEN, which is basically a defense bundle. You have a lot of major players in that, and it trades at a relatively low price, relatively low risk to your capital. But if those sectors pick up or crumble down, you don't lose nearly as much if you were to just buy the tickers themselves. You could do that with airlines, and you can do that with pretty much any sector you want. Up to you what sectors might be appealing, but that's essentially the broad aspect of what an ETF is. You're basically putting your risk on a sector rather than your risk on an individual stock, kind of leveraging your risk. Dividends, stocks, pretty straightforward. Some companies, the more profitable ones, pay out a percentage of a dividend, and that dividend comes each and every, sometimes quarter, sometimes it's yearly, sometimes it's monthly. Dividends kind of collect up. Pretty nice to have if you're a long-term investor, if you wanted to kind of leverage your risk once again. So dividend stocks, ETF stocks, pretty good to have as long as you're doing your proper research into those dividends and why they're generating those dividends and why the ETFs are the way they are. Mentioned earlier about beta, avoid too high of beta stocks, too high of beta ETFs, things like that. And we're going to get into just some basics of options trading here. Options, pretty straightforward. You got buying calls, buying puts, selling puts. If you're going to buy calls, that's up to you. Basically, you're buying a call expecting the stock to go up. If you're selling calls, you're expecting the stock to go down, but you're selling those calls to those people that are expecting it to go up, and you make a profit off of that. Buying puts, you're expecting the stock to go down. Selling puts, you're expecting the stock to basically go up, and then you're making profits off of that. Sometimes there's strategies where you can leverage it where you're, making profit if it stays flat. A lot of different strategies in options trading. I'm not going to go into too many details on that. I just wanted to cover the very, very basics of that. There's different Greeks involved and things like that. Going to get into that in another video, but once again, if you're interested in options and want to learn more, I suggest Tastyworks, a great broker to utilize. They're actively currently, at the time of this video, they're giving away free shares or options, depending on when you're watching this video. All relative to you. Another platform I'd recommend if you're considering options, or if you just kind of want an inside look as to where the money's flowing. Trade UI is a great platform as well. Shows you different option sweeps coming in. Sweeps to fill are basically big money's conviction on a given stock. Options trading, a lot more aggressive because one contract equals 100 shares. So if you see some company buying 1,000 shares or 1,000 contracts, they're putting a lot of money into conviction on that time frame for that money's flow. You know, risk wise, stocks can be dangerous, but if you do proper risk management and you do follow through this properly, you take a very, very low risk. Just some different resource tools that I'm going to get into before the end of the video. I covered FinViz earlier, but I only really covered that they can screen stuff, but they can do a whole lot of other stuff. They can do heat maps, they can do back testing, they could do futures checking, Forex, they can give you updates on news. If you want other updates on news, it's important to do push notifications with a lot of major news sources, CNBC, Seeking Alpha, a lot of these different places, just so that when breaking news comes in, you get it immediately on your phone or on your browser so that you can really actively follow up with what's going on in the news. Investopedia, great resource as well. I used that throughout this video just to cover a lot of this basic stuff. Short volumes, not very complicated. People want to short the stock, expecting it to go down, somewhere to buying puts. But, that's pretty much all this website is short volume up, short volume down, that creates squeezes, things like that. Learning more about how shorting works and, buying the cover and all that stuff and why they create short squeezes is very important to learn. Investopedia has great resources on that. Not going to go into too many details on that. One of the more exciting tools to use is bar chart if you're fairly new to trading. A bar chart kind of gives you resistance points and support points, all that kind of fun stuff. You can use it for simple technicals and get a range of where your stock might be trading. Stock twits, mixed depending on who you're following. I follow short alerts and I follow people that give out option alerts specifically, no real input outside of that. This is the short sale volume. This is the option strike. This is pure technicals kind of stuff. I don't really follow individuals as much in that regard. Let's see here. The economic calendar. Economic calendar, basically pretty straightforward. You can see all the upcoming events for different markets, whether it's the US, China, what have you, what might be coming up, what the potential date is, the forecast, whether it's likely to be guidance, so on and so forth. simple utilization of all this stuff, $100 a day, $24,000 a year, 300 a day, 72,000. Obviously, you can't trade every day, at least not through just basic equities. But the point being is that just a little basic effort on this can add up to a lot of capital, even with not taking much risk. And of course, some other basic things I wanted to cover here are shown in the video at least that you guys can look over later if you want. Basic chart patterns are important to learn. Ascending triangle, triangle, channel up, rising wedge, head and shoulders, triple top, flag. Those are all positive. Descending triangle, channel down, falling wedge, rectangle, inverse head and shoulders, triple bottom, pennant. These are all charting patterns that are very important to memorize when you're actively trading. Keeping them in the back of your mind very, 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 very well helps to, process that whole aspect. Option value, I didn't get too much into this, but options decay over time. The shorter the expiration that you get into, the faster they decay. I'll cover options more in depth in another video, so make sure to subscribe to the channel and like this video. Comment below your own input on what you might want to see in that video. Comment your own input in regards to stocks trading in general as well. We're gonna go some other things to keep in mind. There's bear markets, there's bull markets. Uh, Bear markets take a little bit longer to recover. Bull markets tend to be more prominent, so it's better to be on a bullish positive note rather than a bearish, because statistically it's usually a bullish market in the long term, at least since the 50s. That can always change, but that's just what the data says since then. That's about all I wanted to cover in this video. Just wanted to go over the basics of, stocks and trading and the stock market and all of this kind of stuff to get you guys started if you're a freelancer or whatever. The cat wants to say goodbye, so see you later. Thank you for stopping by. Thank you for watching this video. Thank you for staying until the end of this video. If you want any input on more specific things, I'm going to be covering more in depth about the indicators. I'm going to be covering more in depth about fundamentals, things like that. This was just more of a basics tutorial for those just starting to investing and trading. Make sure to check out all the links to all the resources in the description below. Feel free to comment what other stuff that you might be using, whether it's tools or news or what have you. And I appreciate you staying through the whole video, and I hope you all have a wonderful day. Be covering a lot more videos in this kind of topics, so make sure to stick around and don't forget to subscribe. See you later.